I'm Owen Bigland. This is the Inside Edge video blog. I wanted to do a blog here and address some of the most common comments that I get quite frequently on my YouTube channel here. As a lot of you know, I generally avoid getting into any long debates going back and forth on my YouTube page. As I've said all along, I let my videos do the talking. I'm really targeting this blog to a certain type of individual, and that's kind of my bread and butter with this. The people that kind of want to get ahead, learn how to start creating passive income flows through real estate and through stocks to provide themselves either early retirement or a comfortable retirement down the road. So I know not everyone is going to agree with what I have to say, and I'm totally comfortable with that and welcome everybody's comments. But you know, a lot of people should realize too that, you know, the things that I talk about on my blog here are not theory. This is all practical stuff that I've been using for well over 30 years. So I know this stuff works, and you know, I've learned from some of the best. I've had a lot of fantastic mentors, and that's what this blog is about for me. It's kind of a pay it forward thing for a lot of the people that helped me out in my younger years. I made a promise to them that when I got to a certain level of success, that I would take some time and help people learn some of the things that I've learned and developed over the last 35 years as a Vancouver real estate investor and as well as a stock investor. So one of the ones I want to comment, and this one, I blogged on this before, and this is a reoccurring comment that I will get, or emails I'll get for people, or even on my Twitter feed as well. And it is the reason why I want to address this one, and I do address these type of comments every couple of times a year, is this is by far the biggest hurdle that people will always face. This is what will undo the best laid plans for most people, and why a lot of people don't achieve what they were hoping to in their life, especially financially, but it could be learning how to play the guitar or the piano or other ambitions they have in life. It's all about the mental attitude and the psychology you have to have. You have to be, in some ways, you have to get comfortable with being uncomfortable. We're not in a perfect world. There's always going to be dark clouds on the horizon and reasons to not pursue something or start something. It's never the right time. And so this is the downfall that puts most people, causes a lot of people to fail. So the comment was on a blog. I've done this a few times. On comments I get are, they'll say, you know, Owen, the advice you're giving for people to buy real estate, especially in this ultra hot market where prices are at all-time highs, you're doling out bad advice here. You know, people are setting themselves up for, I think one guy called it a catastrophic loss. They're going to buy a condo today for $600,000, and they're going to lose 3/4 of it over the next couple of years. The market's going to crash, don't you know? And you're telling people to be buying. And you're setting them up for a dramatic crash here, and a loss of most of their net worth. And I'm here to tell these people, and I've commented before on it, I'm not. My clients certainly aren't setting themselves up for any type of catastrophic loss at all, because I educate my clients when we go in to buy their principal residence, their first home, or an investment property. I've blogged about it here for 7 years. You have to have a minimum 8 to 10 year holding period. Real estate does not go up in a straight line. There are always going to be short-term volatility, fluctuations, and price corrections. The last one we had here in Vancouver was 2012. It didn't last very long. By later in 2013, the market took off again, and it's been on a roll ever since. We should get a correction every 3-4 years here. We're overdue for one. But I tell my clients, you always want to buy and go in with a long-term horizon, and that there is never going to be a time in your life, whether that's buying a shares in Johnson & Johnson or buying your principal residence or buying an investment property. You are never going to have a magical time where it's all green lights and blue sky and sunshine. There's always going to be some dark clouds, some unknowns on the horizon. So my clients, I educate them. I tell them, you know, listen, you're going to buy the property. You are paying top of the market right now. as long as you've got an 8 to 10 year holding period or longer, the longer the better, you're going to do fantastic. Matter of fact, I can guarantee to someone if they bought a Yaletown condo today and paid $500,000, 20 years from now it's going to be worth probably double or triple what you paid for it. But all bets are off on what that condo, Yaletown condo, is going to be worth 2 years from now. For all I know, it might go down to $450,000. But real estate is forgiving. You give it enough runway and it'll recover. And people have to realize this. If you don't, then I hate to be blunt about this to people, but I have no other way to put it. If you can't get comfortable with that, knowing that there's always going to be some uncertainties, and pull the trigger either on a purchase of a house or investing your money, getting it to work for you, then you're going to be stuck on the sidelines forever. Or you're going to be putting your money into a bank account, earning 0.5%, getting taxed on it at your full marginal tax rate and losing 2% every year to inflation. So by doing that, you're essentially guaranteeing failure. You have to get your money to work for you, and the two best ways to do that, you're going to have to get your money into a market situation, whether that's real estate or the stock market. That will give you your best return and your guaranteed best return over the long term. The one caveat though is unfortunately in a perfect world it would be great if we all bought real estate or bought a share in Johnson & Johnson or TD Bank and it went up indefinitely forever and paid us a nice dividends we held it. But unfortunately that's not the way the world works. When you're dealing with a market situation, in the short term, it's what's known as a voting machine. People's vote, they vote whether the market's going to be hot and continue to go up, or they get pessimistic and the market goes down. That's the way markets work. But you have to get comfortable with that, and you have to come to the realization that that's just how markets work. And if you can't, then you're going to be in for a whole world of hurt. You're just not going to be able to get your money working for you. Now, the other thing I'll just comment briefly on here, I always love how these people will comment and say, you know, the market's going to crash, and that's really about all they ever say. It's crashing and you buy today and you're nuts. But they never give us what their game plan is. Enlighten us a little bit with your crystal ball here and tell us what your game plan is. Now, if someone doesn't feel that the time is right now to buy a property, they think the prices are too high and they're going to come down next year or 6 months from now, I can totally understand. And it's no problem waiting on the sidelines for the correction. But you should have a game plan. And I've blogged about this before. You better have all your ducks in a row, as they say. So that means you should be pre-approved for a mortgage, and you continue to renew that every 90 days if you haven't bought anything. You've got your $50,000, $60,000, $100,000, $150,000 down payment funds ready to go in a checking account. And you're starting to keep an eye on properties, the prices. You've got a realtor, and you're out there looking and waiting for the buying opportunity to come. Now, I can tell you that if I ask most people that are saying the market's going to crash and you're crazy to buy and they're pessimistic as all can be, none of these guys have a game plan. So even if this market, or when this market correction comes, not if, when the market correction comes, because it will, markets don't go up forever. We're eventually going to get a breather here. The market's going to start to level off, and then prices are going to go down, and we're going to get back into a buyer's market instead of a hot seller's market. But when it does, most of these people, 99.9% of these pessimists, are not in a position to take advantage of it anyways. So why are you wasting your time complaining about the market when you're not even in a position to take advantage of it when it does come? But I sure would love it if some of these armchair quarterbacks, some of these doom and gloomers would enlighten all of us with their plan of action here. When are you going to buy back in? You think that $600,000 Yaletown condo is too expensive, way overpriced? Fine, I can understand that. What is your strike price? Because that's what you need to have. I've done blogs on this before, on the psychology of people who are timing markets and why it almost never works out for them, ever. Because they set a strike price. Let's say I'm going to buy back in then when that Yaletown condo hits $550,000. I've got my ducks in a row. I've got my $100,000 down payment. I'm pre-approved for a mortgage, and I've got a strike price. Okay, that strike price is $550,000. Okay, let's say 2 years from now, the market turns. prices start to go down, and over the next 6 months, that Yaletown condo goes from $600 to $550. Do you think those guys are going to buy at $550? Never. It won't happen. I've seen this firsthand in so many corrections. I've been in this game a long time. I did a blog about it back in 2012, how I talked about all these market timers as the market was going up in 2011, early 2012, and then we took the correction in late 2012. All these people that were coming through my open houses saying prices are peaked and the market's going to crash. Market went down 10%, but they were nowhere to be found. The reason is it's so difficult to pull the trigger on a strike price when the market's going down. Try doing it. Very difficult to do, if not impossible to do. Because the prices came down 10%, you're telling your friends, I'm going to buy now. That Yaletown condo's down $40,000. And they would say, are you crazy? Why would you buy now? Prices are down 10%. They're going to go down another 20 or 30. Why would you pull the trigger now? Just wait. And this is how it always goes. Next thing you know, market stays flat for a while, it's down 10%, it treads water for 2 or 3 months, and then we're back off to the races again, and you missed it. So you'll never know where the bottom of a market is. You'll never be able to time the bottom of a market until after the fact. You'll be able to look back on it and say, yeah, in January of 2013, that's where it bottomed, and then it went up from there. You'll always be behind on it. So that's how I would address a lot of these people that comment on my blog here about timing markets, and you're giving advice here to be buying in this market and setting yourself up for failure. You're not. Not if you adhere to the rules and how successful investors do it. Buy every property with a long-term holding need. Now, you could buy that Yaletown condo today, and a year from now or 2 years from now, it goes up another 100,000. That's great. I had a guy comment here a while ago talking about, I told him about pre-sales were being, pretty expensive, and you might want to avoid buying pre-sales now because you're paying an ultra premium. The guy commented on the blog here saying that, that's bad advice. I had a friend who bought a pre-sale 5 years ago for $300 and just sold it for $600. Well, that's great. Congratulations. That can happen too. But the point I'm trying to make is that if you plan on buying a pre-sale today and with the intention of flipping it a year or two from now for guaranteed profit, you're crazy. There's no guarantee that it will increase in that 2 or 3 years. As a matter of fact, it could be down 10 or 15%. He then went on to say that your advice on diversifying and going into dividend stocks was a bad idea too. My friend bought the condo, made $300,000, and I bought some good dividend paying stock, and it went from $23 down to 19 cents. Sent me the ticker number, a symbol of it. It wasn't a high quality dividend stock at all. It was a penny stock that trades in Bermuda. Hardly what you'd call a blue chip S&P 500 stock. So he bought the wrong stock for sure. But remember, it's all about the psychology. There's never going to be a time in your life with anything where it's all green lights to go and clear blue sky. You have to get comfortable with wading into a market situation where the price is going to fluctuate. But as long as you keep that long-term horizon, you've got the runway there to outweight any short-term volatility. And that's as simple as that. And you have to get that through. That's why so much of my new book talks about this. As a matter of fact, the first 2 chapters, I set up the entire book with the mental attitude and the thinking you have to have. If you can't get past the first 2 chapters in my book, then you may as well just throw it in the garbage. You have to develop that. If you can't, then you're going to be stuck earning minimal interest, paycheck to paycheck, and taxed heavily on your income. It'll be very difficult to retire comfortably. I'm Owen Bigland. As always, I know this one rambled a bit. Thanks for watching. If you haven't subscribed to my YouTube channel, please do. I'll see you next week.